This week wasn't about good news. It was about less bad news. Markets didn't suddenly become stable. They simply stopped pricing in the worst case scenario. And that small shift was enough to move everything. Let's break it down properly. So what actually happened? This was a relief-driven, risk-on week, but it wasn't built on certainty. It was built on reduced fear. We saw de-escalation signals out of the Middle East, a sharp pullback in oil, inflation still lingering in the background, and positioning ahead of earnings season. The key point here is simple. Risk didn't disappear. The market just repriced the probability of the worst outcome. That distinction matters more than most people realize. Equities had a strong week across the board. The S&P up over 4%, NASDAQ over 5%, Russell pushing nearly 5%. But the real insight isn't the numbers, it's the composition. This was a growth-led move. That's typical when volatility drops, rate expectations stabilize, and risk appetite comes back in. Even the Russell performed well, which tells you this wasn't just a mega cap rally. There was real participation. Now, commodities told a slightly more nuanced story. Oil dropped over 15%, and that's not a normal move. That's a repricing event. The geopolitical risk premium that had been built in was aggressively unwound. But at the same time, gold was up, silver was up. So what's going on? Simple. Oil is telling you short-term inflation pressure may ease, but metals are telling you the longer-term inflation story isn't resolved. Two different timeframes, two different messages. Crypto behaved exactly as you'd expect. Strong gains across Bitcoin, Ethereum, Solana. This is classic risk-on behavior. When liquidity expectations improve, fear drops, and volatility compresses. Crypto tends to move early and fast. It's often one of the cleanest real-time indicators of sentiment. In effect, the story was straightforward. The US dollar weakened across the board. We saw strength in the euro, pound, Aussie dollar, and importantly, USD/JPY barely moved. That matters, because in a true risk-off environment, the yen strengthens aggressively. The fact it didn't tells you this was an orderly shift in sentiment, not panic. This is the most important number of the week. The VIX dropped nearly 23%. That's not a drift lower, that's a reset in sentiment. When volatility compresses like this, risk assets rise, correlations tighten, traders become more aggressive. But here's the warning. Low volatility doesn't mean low risk. It usually means risk is being underestimated. Now, under the surface, things weren't uniform. Yes, indices were strong, but individual names told a different story. Amazon up over 13%, Meta strong. Nvidia strong, but Tesla down, Palantir down sharply. That's not random. That's rotation and selectivity. So this wasn't a buy everything rally. It was targeted. This is the key lesson from the week. Markets don't move on facts. They move on expectations. We shifted from what if everything breaks to maybe it won't be that bad. That shift alone crushed oil, lifted equities, weakened the dollar, collapsed volatility. Same world, different pricing. That oil move deserves respect. A move like that tells you the market had been pricing in extreme outcomes. And when those expectations changed, price adjusted quickly. That also fed directly into inflation expectations, equity sentiment, and risk appetite. Oil right now is more than a commodity. It's a macro signal. But let's be clear, inflation hasn't gone anywhere. Energy prices are still elevated over time. Core inflation remains sticky. So central banks are still stuck. No clean pivot, no easy path. This creates the kind of environment where traders overreact, misread signals, and get caught between narratives. Volatility compression creates opportunity, but also risk. When markets calm down, traders increase size, leverage builds momentum, accelerates. But eventually, that risk comes back. And when it does, it tends to move fast. This week was driven more by narrative than data. Geopolitics led. Energy routes mattered. Ceasefire discussions mattered. Cost of living pressure mattered. This is important because narrative-driven markets can move quickly, reverse quickly, and ignore technicals temporarily. And geopolitics, still unresolved, still critical. And finally, the US dollar. Is this a trend shift or just a pullback? That's the key FX question. This is where traders usually get it wrong. They see strong markets, falling volatility, and they assume bullish. But trading doesn't work like that. You need to separate higher time frame, still uncertain, medium time frame, relief rally, lower time frame, bullish momentum. All three can exist at once. At CLiK, we don't predict. We focus on where price is, where levels matter, and what probability looks like there, because markets don't reward opinions. They reward execution. Markets don't need certainty to move. They just need less uncertainty than before. That's what drove this week. The move was real. The drivers were valid. But the bigger question now is, does it continue? Or was it just a repricing? Let price answer that. If this helped bring a bit more clarity to your week, consider subscribing and following along. We break this down every week, focused on structure, not noise. Trade well, stay disciplined, and we'll see you in the next one.